Silver didn't collapse because it was weak. It collapsed because something triggered it. When silver fell from $121 to $64, financial media called it a correction. Analysts said it was overdue. Commentators nodded confidently and told retail investors this was what happens when speculation runs too far. And most people believed them. They believed the bubble had burst. They believed the rally was fake. They believed price had finally found its true value. But what if price wasn't discovering value at all? What if it was executing a mechanism? Before we go deeper, if you appreciate this kind of analysis, not hype, not noise, not emotional trading, but structural decoding of how markets actually function, take a second and subscribe. These videos take serious research and time, and I don't chase trends here. I study patterns. If you value clarity over entertainment, you're in the right place. Now let's examine what really happened. On paper, silver's crash looked dramatic but simple. Price peaks near $121. Momentum fades. Sellers enter. Panic spreads. Price drops to $64. End of story. Except that's not what the data shows. Because when you overlay margin requirement changes, open interest shifts, commitment of traders reports from the U.S. Commodity Futures Trading Commission, and physical market premiums, the narrative completely fractures. This wasn't voluntary selling. This was forced liquidation. On COMEX, the primary futures exchange for silver in the United States, traders do not need to pay full value for their contracts. They trade on margin. During the peak of the rally, initial margin requirements were roughly 5%. That means a trader could control $100,000 worth of silver with just $5,000 of their own capital. The other $95,000 was effectively borrowed exposure. That is 20-to-1 leverage. Now leverage feels powerful on the way up. If silver moves 5% higher, a trader using 20-to-1 leverage effectively doubles their equity. A $5,000 stake becomes $10,000. But leverage is symmetrical. If silver falls 5%, that same $5,000 is gone. And when it's gone, the exchange does not ask politely what you would like to do next. It liquidates you. That is a margin call. And margin calls are not emotional. They are mechanical. Now here is where the timeline becomes interesting. Margin requirements did not remain at 5%. They increased. First from 5% to 8%. Then from 8% to 11%. Then to 15%. Then to 18%. 5 increases within roughly 9 days. Let's break down what that actually means in numbers. If a trader controlled $100,000 of silver exposure at 5% margin, they needed $5,000 in capital. When margin rose to 8%, they suddenly needed $8,000. That is a 60% increase in required capital immediately. Not over a month. Not next quarter. Immediately. Many did not have the extra $3,000 sitting idle. Their positions were liquidated. That liquidation pushed price down. Then margin rose again to 11%. Now the same trader needed $11,000 to hold a $100,000 position. That is more than double the original requirement. But here is the critical detail. By the time margin reached 11%, silver had already fallen from $121 to around $105. So traders were already facing unrealized losses. Now they needed more capital to hold losing positions. More liquidations followed. When margin jumped to 15%, the capital requirement tripled relative to the original 5% structure. A trader who entered at peak leverage now needed 3 times the initial capital to stay in the trade. Then at 18% margin, that $100,000 position required $18,000 in equity. Nearly 4 times the original margin. By that point, Anyone who had structured their strategy around minimum margin was gone. And here's the part most people never examine. These increases happened during volatility spikes. Silver would drop sharply, 3%, 4%, sometimes more in a session, and within hours or a day, a new margin increase would be announced. If the goal were to stabilize markets, logic would suggest pausing increases during high volatility to allow traders to adjust. Instead, volatility was amplified. Each margin increase added pressure to already stressed positions. Losses plus higher requirements plus limited response time equals forced liquidation. That is not a correction. That is a cascade. Now let's introduce another data layer. 3 weeks before the first margin increase, the Commitment of Traders report showed small speculators holding one of the largest net long positions in silver futures in 5 years. Retail traders were heavily exposed, optimistic, leveraged. At the same time, commercial traders, typically large institutions, bullion banks, mining companies hedging production, were holding one of their largest net short positions in 18 months. This setup matters. Because when price is rising and retail is heavily long while commercials are heavily short, the market becomes structurally fragile. If price falls, retail is vulnerable to margin pressure. Commercials, with deeper capital reserves, can withstand volatility. Now look at trading volume. In the 48 hours before the first margin increase announcement, large block selling appeared in the market. Institutional-sized orders. Not frantic. Not chaotic. Methodical. Then the margin increase was announced. Then retail liquidations began. And price accelerated downward. This is the part most financial media avoids because it requires structural analysis rather than emotional narrative. Markets are not just driven by fundamentals. They are governed by rule-making bodies. Exchanges control margin requirements. They control position limits. They control trading halts. When you trade with leverage, you are not just taking price risk. You are taking rule change risk. And rule change risk is asymmetric. Retail traders calculate volatility, technical levels, support and resistance. Very few calculate the probability of margin requirement shifts during volatility spikes. But the silver timeline demonstrates something powerful. Margin requirements increased from 5% to 18%, a 260% increase in capital required to maintain the same position, in just over a week. That is not minor adjustment. That is structural compression. And once leveraged capital is purged, price finds a new equilibrium not based on voluntary reassessment, but on who survived the purge. Now let's step back. Was silver overvalued at $121? Maybe. Maybe not. That's not the central issue. The central issue is that price movement from $121 to $64 was heavily influenced by forced liquidation mechanics rather than purely by informed valuation decisions. When traders are liquidated automatically, price becomes a reflection of margin capacity, not necessarily intrinsic value. And that distinction changes how serious capital should think about exposure. Because if you control an asset through a leveraged derivative contract, your ownership is conditional. It exists only as long as the exchange's margin requirements remain compatible with your capital. The moment those requirements shift beyond your liquidity capacity, your position is terminated. In contrast, holders of unleveraged physical silver experienced a paper decline in quoted value, but no forced sale. They still owned their asset. No margin call. No automatic liquidation. No exchange authority closing their position. Temporary volatility versus permanent capital loss. Two completely different experiences from the same price chart. This is why the silver crash from $121 to $64 is not just a historical event. It is a blueprint. A blueprint showing how leverage can be transformed from a profit amplifier into a liquidation trigger. A blueprint showing how timing of margin increases during volatility can accelerate declines. A blueprint showing how retail positioning extremes combined with institutional capital depth create asymmetric survival dynamics. And most importantly, a blueprint showing that in markets where exchanges control the margin trigger, leverage is rented privilege, not ownership. Now here is the final layer. After the purge was complete and price stabilized near $64, open interest began rebuilding slowly. Institutional positioning shifted. Commercial short exposure reduced significantly compared to pre-crash levels. The same institutions that were short near the top had reduced exposure near the bottom. That is not conspiracy theory. That is positioning data. And positioning data tells stories charts alone cannot. The lesson is not that markets are rigged beyond participation. The lesson is that structure matters. When deploying capital, it is not enough to analyze supply-demand, macroeconomic conditions, inflation trends, or currency debasement narratives. You must analyze the plumbing of the market itself. Who sets margin? Who can change it? How quickly can it change? How leveraged is the current participant base? What does commitment of traders' data reveal about positioning imbalance? Because when the next volatility spike hits, and it will, in some asset class, somewhere, the same mechanics can reappear. A crowded trade, high leverage, institutional positioning asymmetry, a volatility trigger, then margin adjustments, then cascade, then headlines explaining it as inevitable correction. The silver crash from $121 to $64 was not random chaos. It was precision under the surface of apparent disorder. And the next time someone tells you an asset collapsed because it had to, ask a different question. Did fundamentals change? Or did margin requirements? Because in modern financial markets, sometimes the fire alarm isn't about the building burning down. Sometimes it's about narrowing the exits. And the only question that will matter when that happens again is simple. Do you own the seat? Or are you just renting permission to sit in it? If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.